Alrighty, guys. Welcome, chill investors, and hopefully future chill investors. All right, guys. Now, Sundays, we have switched it up, and I'm going through chart requests, and I'm going through student request sections. And that's what the video is going to be. So if you do have questions or charts you want reviewed, go ahead and put them into the request inside the Discord. So let's go ahead and take a look at a few of the student requests to start off. So first one is coming in right here. It says, in the journey of generating income and growing your account, yes, we look for CSPs and CCs, cash secured puts and covered calls. How do we take advantage of some strong sectors and strong stocks that have an uptrend and beat the 2 to 3 earnings, which is key, like the GLW, WD, MU? Since our accounts are small, we can look at other income generating strategies or leap calls as right setup to take advantage of the trend as well, grow the account. We can look for $10 wide VPCS, bullish, and close the targeted returns. Need to learn all the aspects. There's a lot going on in this question. Need to learn all the aspects, but ultimate goal is to generate income and support expirations, support EXP, expiration, and grow the account. Experience. Sorry. What do you think? So a lot to unravel, and I want to keep it really simple, because when you try to complicate things, you start realizing that some of each technique almost negate each other, and therefore you feel like you will never enter a trade. So keep it simple. We talked about this a little bit, but to dive in how I find the best way to grow your account, okay, is doing a CSP. And when you do that CSP, go ahead and use the premium amount to buy leaps, okay? Because that way the stock goes up, you have the leap to capture all the upside, right? If the stock goes down, you'll get to own the stock, and it's a leap. You have plenty of time on your side for the stock to rally, right? And then the next time it goes down, you get to do another CSP. You'll buy another leap. It'll dollar cost average down for you. So that's the best way I found to grow a smaller account, because when your shares are flip-flopping between CSPs and covered calls, right, you have a chance of those getting called away and then missing additional upside. But if you do a leap, okay, so for example, if we did HIMS here, obviously we're all, at least most of us are bullish on HIMS, right? You do a CSP here, say I'll buy it for 24, whatever it may have been, okay, and you get paid $1,000 in premium. Let's just use it as an example. Okay, you're going to take that $1,000 and you're going to go buy January 2028 $30 leaps. Cool? So $30, whatever 70 to 80 delta is. Okay, that's what you're really looking for in the leap side of things. So let me go ahead and throw up the chart real quick. So you can see here, we have this this new uptrend happening. We came up, we pulled back, held this 100-day moving average, as well as pulled back to the 0.5 Fibonacci. Okay, this is where you could start setting your CSP, because we got pretty dang close to what we were talking about, that 24, right? You could, any of those big red days that we had was a day you could have set a CSP for this 22, 23, and then taken that money and bought a leap, like a 20, 80, 70 delta leap. And again, if it's too much money, that 70, 80 delta, and you don't have any extra to put in, then you do need to go a little bit more aggressive to try to grow this account. So you maybe need to go to a 60 delta. It's not that crazy when it's a 2028 long-term leap. It's not the end of the world. But we try to do 70, 80, but 60, 50. I really wouldn't go below 50. If you're doing below 50 on this kind of strategy and leap, you either need to be extremely bullish and understand what you're doing, or you need to wait, I guess, till you do another CSP and another one and get your account a little bit closer to where you can afford the leaps on it. But anyway, 70-80 delta leap 2028. And that way, when this runs back up and we hit this little 38-40 wall right here, okay, you can set covered calls on your shares if you got assigned. And if you didn't get assigned, no worries, your leap caught the upside. But if you did get assigned and then you set covered calls up here and then the stock kept going, your leap captured that upside. Okay, your shares might get called away, but your leap continues to grow as that rally continues. And that's what's important. Now, I don't go and buy leaps when I set covered calls. And the reason before it is because when you kind of set a covered call, you believe that the top is pretty close. There's no reason to go ahead and buy a leap when you think that the top is there, right? You hit this top and you're like, well, let me buy a leap. Why? You thought it was the top. When it comes back down and you set a CSP again, then you buy the leap and then you'll capture the next upside. That's how you would do it. MU, for example, I mean, guys, there's going to be outliers in the market that just run, right? So anytime you've been able to set a leap, right, buying and adding down here, trim, 10%, 10%, 10%, 10%, 25%, 10%, and then you're still going. But anytime you were doing CSPs or you had this pullback and you did a CSP, I can go to the daily time frame and see, add here, okay, touch the moving average, touch the moving average. So anytime you did like CSPs in these pullback zones, okay, you could have bought a leap to capture this upside while doing covered calls and collecting premium, okay? So that's all that is just being able to go ahead and still generate premium, but then your leaps capture the upside of it all. So that's how I would do it as far as making sure that you're generating enough income, as well as being able to buy leaps. Now, you don't have to use all the premium to buy additional leaps. You can use, if your account's to the size, you can use half of it to buy leaps, half of it to live off of, whatever it may be. So that's what I got for you. This next question, leaps. Love for you to do a video on leaps, like the idea of taking your CSP premium, buying leaps. Just not sure what to look for in leaps, what strike price. Do you ever go further out, like 2028, stuff like that? So yeah, leaps, by I believe definition, is pretty much 1 year or more out. So that's what I look for, basically. But I kind of, for some reason, you gravitate towards the January. So January 2027 is now like basically 6 months away. Okay, so now you're kind of looking to January 2028. That's going to be your first one. And then anything further is just extra. But January 2028, a year and a half of time is plenty of time. But again, you're doing those when you place your CSP. So year or more, and pick your normal dates. So January, because you're going to get the year-end Santa Claus rally that we didn't get apparently last year, right? And then you have usually beginning of the year, guys, there's always the stress between January and April is always a stress of a market pullback. So I don't want really an expiration date in that time frame. Okay, usually between January or December, December, because if you have a January, you're never holding till the end, guys. You always want to get rid of your calls. You know how we set cover calls and CSPs for 45 days? You don't want to hold it closer to 45 days. If you're up big, take your wins, guys. Take your wins. But 70 to 80 delta, 1 year or more out. I look for January because then I can sell it in October, November, as like August, that rally ends up being there and we're only a couple months away from expiration, take your win. And then if I'm doing that, I'm really doing, again, this is kind of the summertime is when you're going to start seeing, like, we're going into summer, like sunshine, everything. That's when you're going to start seeing the rallies again. And then, so I don't know, I just kind of stick to January is really what I do. January 2027, January 2028, 29 eventually. But if you want to choose March, you can choose March. Just know that usually between January and April, there's some sort of correction in the market and you don't want to be caught holding them. So just be aware. 70-80 delta is just because every dollar that the stock moves, the option moves basically 80 delta, 80 cents. It moves 80 cents per share in a contract, which one contract is 100 shares. So that's why we pick 70, 80 delta, because it moves very similar to how the stock moves. So that's why we do that. Next question. Stock is upper band, but you don't have shares. Any strategy for safe CSP to collect income as portfolio strategy? And if so, what to look for? Any more details you can share with your new income generating leaps plan strategy framework benefit team? A video on how you can make 2-hour chart read short-term swings. Sorry, I'm reading the next questions. So I'm right here. A video on how to make a 2-hour chart read short-term swings, either share or aggressive options to collect and grow your account. Okay, so I'm not the biggest fan of short-term, but just because, again, you have to be prepared to lose it all. And if you're consistently compounding every 30 days of income and generating on wheel strategy, right, you can quickly lose it with these short trades if they don't go your way. Okay. Disclaimer, that's what I'm going to say. Now, let's start with the first question. Stock is in the upper Bollinger Band. I'm going to go to HIMS because HIMS is the perfect one for this, right? I'm sure HIMS was in the upper Bollinger Band. Get rid of that. Let me clear this up. We can do the wheel table and Bollinger Bands. And I'll just get rid of the moving averages here. Alrighty. So, top half of the band. Okay? HIMS. Now, for me, I am a mega bull of HIMS. No questions asked. I like the company. Long-term, short-term, whatever you want, I'm a fan. So you have to obviously know the company, been following the company a long time to understand how the price action kind of works. If you can learn the Fibonacci levels and how to draw retracements, that's good too. Here's a trend line, right? There's other tools that are manually, let me show because I forget to always do this. Okay, here's the HIMS chart. We're on the upper Bollinger Band. If you take a look, right, we are this top band, middle band, bottom band. Okay. Now, if we take a look here, we have this trend line, right? And we thought that the Fibonacci levels here, if you knew how to watch our video on drawing Fibonacci retracements so you can understand where things may pull back to and where they will find support, a great tool to know how to use, okay? I think it's one of the easiest tools to understand, like, hey, if this was to start pulling back, where would I see a pullback to? Great tool to use, okay? As well as moving averages, but which this held the 100-day moving average perfectly, which is awesome to see. And then it slowly retraced down to the 0.5 Fibonacci. Great, okay? So how I like to do things, if you're bullish on the company, what I will do is almost the opposite of a CSP, but it acts kind of similar, okay? So, hear me out. And I've done this a few times in our chats, in our channel, and everything like that, because I'm super bullish and I think a catalyst is coming, but I still want to protect myself to the downside. I understand that I'm capping myself to the downside, but I know what I'm going to make if it does go and hit my targets in the next 30 days. Okay, so let me pull this up real quick for you. 2 seconds, if I can get a, there we go. Oh, that's my old job stuff. 1 sec, sorry. There we go. Pull up charts. And pull up our, oops, I don't like that it hides. I'm still getting used to using a Mac here, okay? Alrighty, so let's go to, so let's go to this. All right, let me show you here. So on this account, okay, this joint account I have, if you were interested in HIMS, okay, what you would do for me, obviously, huge run up here, but you're worried about, right, the downfall, and you're trying to figure out how to go ahead and get these shares, but also it's on the top half of the Bollinger Band. What's the top half of the Bollinger Band mean? Covered calls. Okay, so what I've been doing, and it's been working right now, so super happy with this situation so far, is I go ahead and I buy the shares. But the second I buy the shares, I'm setting a covered call. Okay, so I wouldn't buy it at the 29 right at the end of the day at that all-time high, but if I could buy some, as it's creeping up or whatever, and you're like, okay, I think this is a good time to buy. I know it's at the top half of the band, but I should go ahead and set a covered call. So what you do is you'd go ahead and buy it. For me, this is how I've been doing it. It's worked. Super happy with it, like I've said. But let's just say, again, you bought it for the 29. Immediately you buy it, and you go to your 30 days out, June 18th. Okay. And then you go to your 30 delta. Okay. So here you go. So 36. So you have the upside of 36. And then you also are going to go ahead and protect your downside by another $1.60. Okay. You could do a little bit more aggressive. You could go ahead and say, I don't want to do a 30. I want to protect myself a little bit more. Let me go ahead and do the 40 delta, and I'll protect myself $2.25 to the downside. Okay. Again, when you're right here, when we're having those red days and you're not quite to the red band, not saying like right now, but you could say like right here, when we touch this, you're like, okay, let me buy some 25. I'll set my $30 covered call. If it goes up, I'll collect $5 a share in strike price, right? And then if it goes down, I'll protect myself by $2. So let me go ahead and show you that because we talked about this. Right, we come down here, 25 and change. Okay, I don't know what the low was, but 25 and change, you go ahead and take a nibble, right? You buy 100 shares. Then what you do is you go ahead and you can set a covered call for 30. Whatever it may have been, right, for $30. Now you protected yourself, so that way if it does go down, you'll go ahead and make your $1.25, which will lower your cost average to 23 roughly, right? Bought it for $25.25, $1.25 in premium, lowers your cost average to 23, good to go, rally starts. So that's how you can do it when you're trying to be aggressive. Now the tools I want you guys to learn is just understanding how the CSP works, how the covered call works, and how can I use these in different ways? And this is another way I've used them is I go ahead and buy the stock. I immediately set a covered call. I know that I'm capping myself to the upside, but I'm protecting myself to the downside as well, which either way it plays out, I'm happy because long term, I like this company, right? So that's one way. If you are okay with the strike price you place, even if it's at the top half of the band, okay? For me, HIMS wasn't going to go back to 1660 for me. Like, I don't think that's the case. So I would be still comfortable placing CSPs at this lower top half of the band. Not saying when it's up here at freaking 32, but I am saying right here, right? Just getting to this lower half, I can set a CSP in this bottom half of the band. I don't know, 30 days out. Let's go to sell, put. Let me just take a look. Okay. 30 delta is roughly $4 a share down. So yeah, you could have been at 25 placing CSPs for anywhere at 21 to 22, which would have been this lower half. That would have been your first one, right? That's your first one. That's saying I will buy it for here. Then when it does, if it does get down that far, right, down to this red line, maybe that trend line on this bottom half of the band, 22, well, now you can set like 18s, okay, which would be like right here. That's buy number 2, right? You dollar cost average in as it moves down. You can do that. It all comes down to how bullish you are sentiment-wise into the company determines on how aggressive you can be. Now, strategy only, you had plenty of time to do all your CSPs, even on here, bottom half of the band, bottom half of the band. So now it's at the top half of the band, and now you want it, right? This is when the FOMO chasing happens. It's not just like you guys, it's everyone in the world is going to see this thing move, and they're going to want a piece of it now, and then it's going to continue to rally with such a short percentage on it. It's going to go ahead and probably squeeze. But you can see here, this is what I was pointing at. Bottom half of the band was here. You're definitely in the bottom half of the band. I mean, you're down in the bottom half of the band a bunch of times, right? Down here. If you took a look at the weekly time frame, okay, came at the bottom half of the band, and then we hit the top or the middle band, and we rejected it, right? So you can look at the weekly. Are we still at the bottom of the weekly band? Yep, we're still at the bottom of the weekly band. Okay, it's still not a bad time to buy. You still can be good. Like last time it was at the bottom half of the band here was back in 2023 on the weekly. Now you're definitely at the bottom half. You're still at the bottom half, right? So you can look at the weekly time frame if it's a long-term outlook. If it's short-term outlook, stay on the daily time frame, okay? But yeah, opportunities will present themselves. Bottom half of the band here. Again, if you're at the top half of the band, for me, I'm buying, and then I am going to go ahead and set covered calls, protect myself. That's just because I'm more bullish. If I was more not bearish, but just like, yeah, the stock might go either way, then still set a CSP and go ahead and place it to the 30 delta. Just make sure that's your first buy. Don't go as aggressive, right? First buy. If it goes down again, I'll do another one. It's kind of style, okay? So let's go to our next question. Alrighty. We called it slingshot. Yep. Ella. All right. Stock of upper band. Strategy safe. CSP to collect some income. Energy if you want to look for. Okay. Again, it's still at the. I mean, like guys, look at the upside potential. Think about where the company was, where it fell to. Has the company gotten better as well? Then if it still has, I still think anything under 30 is a clear buy for HIMS. So I'm not even mad at in the 28s because I have a long-term outlook that if it stayed down here for the next 6 months, it wouldn't matter to me. I don't think that's the case, but if it did, my outlook is still long-term. Now, if it skyrocketed up to 70 within next week, I don't need to have a long-term outlook to know that I should probably take some of my win off the table and reposition myself and get ready to buy it if it dips back down or whatever it may be. Okay, so that is what I got. Okay, now let's look at any more details you can share with your new income generation and leaps plan strategy framework to benefit the team. Yes. So I put a message out there on our trades and strategy. So step 1, set a CSP. Step 2, take that CSP premium, buy leaps 70 to 80 delta like we talked about. Okay, if the CSP, like I said, gets to 80%, we're just going to go ahead and close it because typically with whatever remaining time is left on that CSP at 80% is probably not worth the time where you could have all that capital back and buy something else and do another CSP and generate more income than waiting for that final 20%. Okay, so just know closing CSPs 80% or more, but that's what I'm looking for. If you're assigned, obviously wait till the top half of the band, set a covered call, 30 delta on a green day, or at least when the stock is above your assigned price if income is needed. So like if I need income guys, again, income is guaranteed, the stock going up and hitting a strike price is not guaranteed, right? So if I have a bill to pay and I need to generate some income I just recently had the wisdom pulled and I needed money to pay for the dental bill. So I go ahead and I generate the income. If I bought the stock for 30 and the stock is at 30, go ahead and set the covered call at 33, 35. It's a win. Take your win. It's fine. It'll be okay, right? So just saying, if I need income, I will set a covered call if it's above my assigned strike price. So if I got assigned at 30 and I set my strike for 30, it's a win, okay? Close my covered calls at 80% or more. Take 10% of my generated premium income into my income ETF portfolio, okay? So the idea behind this, guys, is that I want to get to a point in my life where I don't need to watch it as consistently. And I would like these income ETFs to pay me my, let's just put base salary, right? I want it to pay me my $60,000 a year to pay for my day-to-day life. Sorry, my throat's getting dry. Now, income ETFs have gotten a lot better. So I know there was a lot before with NAV erosion, and they're getting better and better. And, we'll switch up which ones as they get better. But I think for now, the ones we have are fantastic. And I really simplified it down to 4. Okay. And they've actually been been growing pretty well. So you guys take a look here. It's been growing. I don't know. Yeah. We're up 2% last week, That's without, this is up 5% within the past month. That's without the income, but that's without the dividends being paid out. That's just the stock appreciation. So I'm pretty happy with an income ETF that's still getting a 5% in a month stock appreciation. That's amazing. I think so. Again, this is a very small portion of our account. So what I'm doing is, if you can generate, okay, let's just, for my example, the previous month, I think in the message, last message, where is it here? Here it is. So April premium collected $25,000 in premium, okay? Most premium I've collected so far this year in premium was the $25,000. 10% of that goes to the income ETF. So I take 10% of this premium I collected in the whole month, and I take 10% of it, so $2,500, and I divvy it between these 4. So this one tracks the QQQ, this one tracks the SPY, this one tracks the IWMI, and this one tracks Bitcoin. Okay, and Bitcoin is a pretty big yield and everything, so that's why I do it, is because, one, crypto got to have some sort of portion in your portfolio, which if it's an income one, then I'm really not too stressed, and it's the most down one, or was the most down one, so that's the one that's kind of raised up the most, which is what brought the portfolio up. But if we take a look here, okay, and it's going to pull up the spreadsheet so I can just show you guys what this looks like, okay? So portfolio yields about 18.31. The Bitcoin one fluctuates, but roughly 18%, okay, is what I'm looking at an annual dividend per year. So based on my holdings right now, I'm at an annual dividend of about $1,100 per year, okay? Now my goal every month is to try to generate, for me, $2,000 a month into this account. That's my goal. Doesn't mean I'm going to hit it, but over the course of a year, my goal is $2,000 a month. I don't care if one month is $5,000 and one month is $500. I don't care how it gets there, but I want to be able to average out $2,000 a month for the course of the year. Okay, and based on that, if I start with $0, okay, and have monthly contributions of $2,000, and my age is 29, so first year I contribute $24,000. Total annual dividend would be $2,120. Okay. Make sure that's mathing. Yep. Nope, that's not mathing, is it? Yeah, I guess it is, because it's compounding. Yeah. Okay. So there's our annual dividend. Now, if we can keep this up, okay, I don't know how many years you guys plan, but as of right now, for me to get to my 60,000, I think it's 8 years. There it is. So $70,000 would be my annual dividends paid out per year in 8 years. So I need to get basically invested. I need to invest $200,000 into this account over the course of 8 years. I need to get there. Okay. This then pays for my base life, okay, of no extra expenditures, just covering my cost of living as a job. So this is why, if I can contribute 10% of your portfolio into a simple 4 portfolio income ETF that just tracks the standard stock market, right, and can pay me roughly, I would say, anywhere from 14 to 18% consistently, I'm going to be very happy. And if you let this compound, okay, 20 years, we can get to a total annual dividend of roughly $752,000 per year, okay? This is long-term thinking, long-term outlook, but this is what compounding of dividends really looks like. And these are one of the most tax-efficient income ETFs out there. So that's why I use them, because this isn't a taxable account, because I want to be able to use these funds before I retire. So they need to be in a tax advantage account. JEPQ and JEPE are one of the least efficient tax advantage ones. So if I would use JEPE and JEPQ in like a retirement account, not a taxable account. So this is why I am contributing to that, because I would like to get to the point where I can just let that pay me, and then I don't have to focus so much on the wheel to generate the income, and I can focus more on running the wheel to generate more income, or grow the portfolio, I should say, and wait for those higher targets to hit instead of being more cautious and making sure I can generate income for my family. So that's why I do it that way. Let's go back here. So 10%, and then step 7, stop caring about missing out on gains, okay? If there is any, and just keep compounding, guys. If you just keep compounding the premium every month, you will be just fine, okay? Don't worry about, oh man, I said I'd sell it for 50 and it went to 55, okay? It's going to happen. You can roll. You can do whatever, okay? If you roll, just know that it could roll back down to 45, and you get to keep your shares, but you don't get to sell it to 55. You got to wait till it goes back up, and then you can do it again, right? So it all depends on your outlook on the company and what the future holds, and if you think that the time of rolling is worth the capital being held up. Could you to get that capital back and put it into another play and make more than what it is giving you for them holding your money to the new expiration date, right? So that's a personal decision. But if you stop worrying about it and being like me last month, right? April, I generated 25,000. Do I care that I might have missed out on the share price? Again, the only reason you knew that the stock was going to keep going higher, okay, think about this. Let's talk about this right now, because I think this is the part that everyone has a hard time with, and even I have a hard time with it sometimes. Let me show you guys what chart let's go. Let's get it together, guys. All right. So, let's talk about our buddy right here. Okay? Let's talk about this guy. All right. So, I had a covered call for 48. Okay? Here's 48. Here's the top of the band. Okay? Set it for 48. It kept going. It came back down. Okay? Now, it didn't get to 80%. I didn't close it. Okay? Should I have? Hindsight's always 20/20. Yes. But, okay, this is the part where you need to understand it's 61 now. Now, I have a cover call for 48. Expires next week. It is what it is. But if you, okay, if you thought that you would be okay selling a company, it doesn't have to be this exact example, but just in general, if I thought it was okay to sell IREN for $48, okay, and the stock kept going, the question you have to ask yourself is, would you have actually held to get to the 60 or 70, whatever the stock may have gotten to, right? When this stock was running up, let's imagine you didn't have a covered call or a CSP, whatever. You don't have any of that stuff, okay? All you can do is buy and sell. As the stock approached 48 or hit 53, do you think you would have hit the sold button? The only reason you haven't hit the sold button is because that covered call locked you into actually holding the company, right? So when it got to 52, 53, you might have hit the sold button and say, I'm selling, I'm getting out, it's hitting the resistance level, boom, take my win. Comes back down, you don't get in, you're like, it's going to go down more. Okay, it doesn't go down more and it keeps going, and now you're mad, right? The only reason you have a covered call is because you thought that was either going to be kind of the top. You didn't think it was going to go much more. It would pull back. You can get back into it, whatever it may have been. But the only reason that you feel the way you feel about your covered call is because it actually forced you to hold the shares and see where the stock went. Okay, so that's the main thing. So this part about stop caring about missing out on gains, this is a gain you probably would have missed out on because you would have sold it already if you had the option to sell it when it was running. Okay, just keep that in mind because tons of people are like, oh, I'm like, yeah, okay, it's just like this thing. Okay, how many of you actually would have bought in for $5 and held it all the way to 70? I can probably say 99 out of 100 of you probably would have sold from 5 to 17, and then you wouldn't have bought back at 14 because you're like, oh no, it just ran from 5 to 17. This thing's going to pull back more. Okay, and then it keeps running. You're like, oh my gosh, right? Same thing happens with covered calls. You thought that was the top, and then it kept going. That happens. Okay, companies give you an opportunity to get back in, and you just wait for that opportunity. So just keep that in mind. So that is my strategy. That's what I'm going to be working on. We are going to be clearing up some capital, hopefully at the end of this week, as long as everything gets called away, which will be amazing. And then we can start making some other plays and getting back to the basics of the strategy we just went over. Okay. Now, let's go back to our student requests and let's see if there's anything else here. I have a question about what to do when you're full position. So keep your full position, like he says, SoFi, but it keeps dropping. This is one of my top convictions. Holding. Do you keep buying or holding? Yeah, great question. So SoFi. We can use it as the example because it's a great example here. So for me, if I have bought tons of SoFi in this 18 to 16 or 18 to 15 range, I don't keep buying. Okay. Unless, like you said, your position's full. I don't keep buying. Now, if the stock dropped to 12 or 13, yeah, I'm probably going to buy some more, right? Because now it dropped a significant amount to the point where $2, right? So think about this. You buy it at 13, it's got to get to 26 to double. You bought it at 15, it needs to get to 30 to double, right? That's a good enough difference that I can double that money a little bit easier, $4 difference, and it makes sense. But if I bought at 18, 17, and 16, and it's currently 15.75, I'm not buying more. I need it to drop a good amount if my position is already full. Also, if your position's full, but let's say you were in the IREN trade and you won, right? You made a 30, 40% win on that one. Well, you can take those gains if you want and then put it back into your highest conviction stock if the opportunity is still there. You can still add to that position because your portfolio just grew and now technically your allocation percentage has shifted, right? So you can still add to that position. Now, when my positions are full, I wait for the opportunity to present itself to the point where, hey, it doesn't make sense for me to keep buying at the prices I could have already bought at and did buy at. So if this loses support at the next leg down, I will buy more. Okay. And that's kind of where I'm at with SoFi. Like I bought in tons in this. I still held some that I bought down here. And then because I'm never going to get rid of these are my long-term portfolio. But these, okay, I bought in tons. The next leg, if it was to drop, would be where I buy more. But I don't think that's happening. Who knows though, right? But we got our first buy, and then now, again, we could get another buy because it came back below that. So once it pops back over that white line again, you'll get another one. The good news is this RSI has not crossed back under this, which is a good sign because when it does cross below, obviously, it does do quite a bit of a drop. So we like to see that it is staying right above it. So I remain bullish. This is still curling. So we're good there. So yeah, I like to see there be an actual difference in the prices I bought it for. If it's still in the same prices I bought for and it's just consolidating there, I'm not really adding more unless, like I said, you had a big win on something else and you're like, well, this stock that I have huge conviction for is still down there. Let me take some of those winnings and buy more. But if your position's just full and your account hasn't done any crazy other wins or anything like that to buy more of something that's undervalued, I'm not doing anything until it's significantly or dropped a good amount below where my last buys were. Okay. So like I said, if your buys were already 16 or 1650, right, in the 15s isn't a huge difference if your position's already full. Now, if your position's not full, then yeah, buy some more down here. If your position's full, I'm waiting for it to drop somewhere in this bottom zone where this one was. Bottom, right? So that's how I do it. Can you create a card in the classroom for position management? Let's say you are going to buy 15K position in ONDS. How do you build out that position? How to use the indicator to trim and sell percentage-wise? Try to make this make sense. Okay. It's hard to put it on a card because the math is a moving obstacle. So here's how the math works. Okay. Let's go to daily time frame. Okay. Let's go to the indicator. Okay. There's that. Don't need any of that. Let's just go to this. Okay. So for me, how this works, okay, is, again, it's not financial advice. It's up to you guys. It's just based on what I've seen on backtesting and how the backtesting has worked in the past, is buying. And I think I do have a card. We can take a look here. Hold on. Let's see here. Go to classrooms. There's, it's right under student request. Classrooms, student request. Classroom, right here. So choose the investing amount, like you said, right? You said you're saying 15,000, so we'll just go with the 10,000 example I have here. So if you get a buy, okay, 25% of cash available for your position. Okay, and the reason behind that is, if we take a look here at, again, you know our bull bear line. So we have a moving average line that we like to be on the daily time frame and then like to be on the weekly time frame. Okay, so here, let me go to show you. Okay, so right here, this is all weekly time frame. So you would have bought, if you had $10,000, right, you buy 25%, so that's $2,500, depending on where the price was, but it looks like right on that blue line. So you could have bought another. So now you have $7,500 left, right? Because you bought 10,000, you had 10,000, and then you bought $2,500. This is why the card is not the easiest to do, is because, well, it is a moving number. Okay, so now you have 7,500. So now you can only use 25% of that on the next buy. So now you can use $1,875 worth, okay, to buy here. So 25% of what cash position is left is what you use on buys. On ads, it's 10%. So again, 10%, depending on how much you had left. So trim and ads are 10% of whatever. So if I had, right, 2,500 plus the 1875 is 4,375. Okay, when you get the first trim, that's 10%, you're trimming of that. Whether or not you want to do 10% of your shares or 10% of the dollar amount, that's up to you, but 10%. Okay, now for me, when I get another trim and trim at the same level I already trimmed, I'm not interested. It's the same way we buy, but if we already bought at that same level and my position's already full, right, no need to trim again or buy again. I already bought there. But 10%, 10%, 10%. So it's a moving, right? So if you already trimmed 10%, now you have a new percentage of your holding. So now you trim 10% of that. Then when you get to here, whatever holding you have left is 25% of that holding. So now you're trimming 25%. So if you had 4,000 left and you're trimming 25%, you would sell $1,000 worth of your shares. Okay. And you go up here, you're trimming, now you have $3,000 left. So now you're trimming 25% of that. Okay. So it's always a moving target of the percentage you're moving. So now again, we cross below this. Again, whether or not you're listening to gray candles, neutral zone, up to you. Neutral zone, that's up to you, right? It's not undervalued, it's not overvalued. We talked about this one on earnings day, right? This was earnings, it was up, and then it was dumping, macro news, everything. We personally talked about this one, but again, if you were to do anything, you could have bought. Again, we talked about the whole market as a whole, right? And this is kind of was a pump fake because pre-market and everything, earnings was pumping, right? We were pumping. So obviously, if you're watching the market, you understand what was happening then. And then the bad macro news came out, and then everything went to shambles. So now, okay, you're under the blue line. We're not doing anything. We're going to the weekly time frame. Okay. For me, the weekly time frame is a double up. Okay. Double up. When we're under the blue line and the weekly. So these are double ups. Okay. This was the daily. We did the daily time frame on this one. We're not doing anything. Okay. But what do I mean by double up? So a weekly happens. Okay. Double up. That's a buy. So if I have $6,000 to put left into SoFi, instead of it being 25%, that is a 50% buy. So now I just spent $3,000 to buy here. Okay. Now waiting on another weekly buy, and I'm going to buy 50% of that $3,000. Okay. So that's $1,500 more into SoFi. See how like the averaging in fluctuates. Okay. So it's a rolling total. So whenever I'm trimming or selling, it's always based off 10% or 25% of the position I hold. Okay. Buying and adding and buying is always 10%, 25% of the cash I have left to finish out my position. So that's why it's hard to put it on a card. I can only put it on the way I had it here. So 25% cash available on your position. Add is a 10% cash available on your position. Oops. Trim. Oh, this says 15. Maybe I did switch it to 15 because there wasn't as much. Up to you. You could keep it 10, 25. Trim was about, I guess, 15%. Unless I type it. I'm going to have to look at that. I might change it, but we'll see. Anyway, 10, 15%. Okay. 25% on the sells. Now, purple, sell all. Up to you, but again, super overvalued. Things can run, do their parabolic moves, right? Squeeze. Things can happen. But typically purple, and I prefer purple on like the higher time frames just because the weekly and the monthly tend to be, right, the bigger moves. Weekly buys, 25% to 50% of the cash available for your position. I like to double it up, but obviously teach their own. So yeah, that's what we run. That's what we run on this strategy right here. Okay. So if you go to any of these, we can go to, but let me see if they put the quantity. I think I'm not allowed to like choose a percentage on here, but I did do a, like a double up, I think, quantity. Okay, that's the weekly. So let's go to daily here. Okay, yeah. So you can see these are 200. Okay, here's a weekly because this had to be 400, right? Weekly, so that's 400. These are daily, so these are 200s. Buy, ads are only 100. So you can see, and then these are trimming based on percentages. So based on this, take a look here. You get 26 wins, 5 losses, average loss 16%. Whether or not you actually trim or sell it for any of the losses is up to you, obviously. But this has an average profit of 111% based on that. So again, 10%, 25% on the add and buys, and then doubling the percentages on the weekly time frame. Okay. And then trimming, I'm pretty sure this is set up for 10 and 25. But same thing. You dollar cost average in, dollar cost average out. If we go to hood, so you can see that these, again, this accounts for the these account for the, they don't account for the gray candles, whether or not you'd listen to gray candles or not. Okay, me personally, not listen to gray candles. But you can see, why hasn't this counted these as a loss? Because there has been no sales yet. This is long-term investing, right? So you dollar cost average in here, you sold some here, dollar cost average in again. Okay, this is why we do double down on the weekly, because you're double down this 119 buy plus a double down 500 shares instead of this 200, right, at 70, just brought your average down significantly to about 90. Okay, so now you can actually, when this pops over this resistance, it's now a winning trade. So this is why we do it that way. So that's why you've been seeing us, we've been getting weeklies and we've been going ahead and buying your heavier, because those are typically some of the best opportunities to present themselves. Okay, buy, trim. So this has 39 wins, 0 losses, 150% per win on hood. Okay, so now you can see what I'm actually looking at. I always forget to flip that. I'm so sorry. So here's your hood. Sorry, 39 wins, 150% per win. So bought 200 shares here. Then you got a weekly down here, okay? And you bought 500. This is the part where I said, yep, you were down, but then you wait for your weekly, and you were going ahead and, bringing your average down to this like 90 range, and you might have gotten over it and then maybe sold, but we didn't get this, we weren't told to sell. Now we found support, and we're going to go to these next targets, and these will now turn into wins because of your dollar cost average on the weekly time frame. Okay. ONDS, we can take a look here. 36 wins, 6 losses. If you follow the strategy, your average win is 346%. I'm assuming your loss came in the earlier years, of the company. Whether or not you're in ONDS then is, up to when you start looking at companies. So, but as far as back testing the whole thing in future, or the past, so let's take a look at Archer as well. Okay. So we go ahead here and we got ourselves 15 wins, 3 losses. Average win is 150%. Average loss is 9%. Okay. I'm going to keep rolling with these averages. These are amazing averages. Just going to keep dollar cost averaging in, buying on each diamond, and then you will be successful. So that's inside of, to get the percentages and everything, that's inside of the chill strategy, inside the classroom on your percentages. And this is why, and I'll show you the reason why on here. The back testing strategy, which I realized here, is, okay, this one. If you want to know what the back testing is going off of, it's this right here. Okay, so if you want to see what diamonds it would buy off the back testing, okay, it's going to be off that. Now, let's take a look here and see. Weekly green. Archer, Oscar. Boom, boom, boom. Looks like Oscar is about to go on a rally. Maybe. We'll see. We'll see. But anyway, so yeah, you got the percentages right here. You can keep it simple and do the same 25, 10, 10, 25. Keep it the same, and then 50% on the weekly buys. But that's the percentages. And same thing when it goes to the weekly sells. You can take those more into account if you want to, but they do lag compared to kind of the daily trimmings. So you can kind of see trims up here, trim. So, but you can wait for, if you just want to catch the big moves, guys, just stick to the weekly time frames. You're going to catch the big buys, okay, and then you can hold through all the trims. Here's your big buy opportunity, okay. Same thing. Very few, but buy, big move, right? You bought for 7s, and then it got up to 10s, okay, and then you got buys again in the 7s, and then it went to 18. Buy again somewhere in the 12s, went up to 32. Buy again in the 16s, 15s. Okay, so weekly time frames will catch the bigger moves if you just want to avoid all the noise of the daily time frame action. But if you want to be more active, you can switch to the daily time frame too. The last question we have is using the 2-hour chart to read kind of shorter time frames, catching bigger or quicker moves, and everything like that. Like I said, I'm not a huge fan of it, but some people are, and I understand. So how I do it, or how I would do it, you can see there's a lot more signals to dollar cost average in and buy and everything. So it's tough because shorter time frames. So let me switch the screen. Shorter time frames, right? I don't like to use extended hours personally. Regular trading hours is what I prefer. Okay. So let's see here. Let's play with this just a little bit because I do want to see a few things. That's the year-to-date VWAP. Just want to see if it was. So what helps with the 2-hour time frame is if you, again, learn the Fibonacci's. Okay, I'm going to tell you right now, you guys really should study the Fibonacci levels because what I will tell you is if I draw this bottom Fibonacci and to this top Fibonacci and then see where this pullback goes, and then you saw that it tested the Fibonacci, and then you see you get a 2-hour time frame add or a buy, you are probably going to buy that, and then it's going to go. So grab the bottom, go to the top of whatever that is, okay, and put up your Fibonacci levels. Boom. Okay, came down, bounced off the Fibonacci, gave you the add signal, go ahead and buy, and it takes off. Okay, so if you can learn to draw your Fibonacci's, again, 2-hour time frame. There's only 4 candles within a day, if that. Yeah, 4 candles in a day. So all you're gonna do, let's picture we're like in this zone right here, right? We're creeping up. So as the days are creeping up, you're like, okay, that's the new high. 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 Once it's made the highest point and it starts falling, that's where you leave it. And then wait for it to fall down. It finds it, gives you the add. Go ahead and add and take off. Okay? The reason you're not adding any of these, okay, well, you could actually. So let's do this. Grab the bottom. It's the part where it's, again, so boom. Boom. Those are all your fib levels. Okay. So comes down, touching, boom, bouncing, add, trim. So that's a win. Got 3. Well, you got a win there if you wanted to trim, but add, trim, add, trim, add, trim. Okay. This is a new low. So I'm not buying this. Because this, if you know your Fibonacci's, okay, when the stock falls below your lowest point, it's over. Your Fibonacci little waves is over. It just lost, I can't think of the terminology, but you just lost trend. Lost, whatever it is, you lost it. I can't think of the word right now, but anyway. Once you lose the bottom of your bottom to top, right, making higher lows, boom, 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 boom. Well, now you just made a new low, right? This dropped below this. They just try to get everybody to sell out of their entire position into IREN. and they're going to go ahead and send it right back up. So now that the low's been created, you want to wait. So now you are picking up a new bottom. You're not getting in, which is good. You got out, you trim. So now you got your new bottom, and it's going up, and you're waiting for it to find its highest point. You thought that was going to be the highest point. It wasn't the highest point, right? Because when you draw your lines here, where should it pull back to? It should have pulled back to 42. It never got there. Okay, so then it went higher and went right here. Okay, now it found its highest point, starts falling. You bounce off of it, get your ad, and it takes off. Okay, so again, if you're going to do this and do the 2-hour time frame, you got to pick your 5 to 10 companies you really follow. Because any more than that, it's a lot to keep up with all the charts. Okay, we can take a look at Nibius. Okay, same thing. You want the 2-hour time frame? Here you go. So we're going to grab the bottom. We're going to go to this top, and we're going to draw it across. I can't tell. Well, let me move this cell. There you go. Boom. Okay. Bottom. Well, maybe. Hold on. That did wick down. You see that wick? Boom. Touch your golden Fibonacci on this high point, fell back down, retested the trend breakout. So now this is actually your bottom. Boom. And now these Fibonacci levels are going to line up. Boom. Came down, gave you 2 ads, and skyrocket. Okay. So now, see how this has kind of made its top? What you're going to do, you're going to go here and here. Okay. It still has a little bit more to come down. I still wanted to test one of these fib levels. If it doesn't come down and test one of these fib levels, then I would keep this moving as it makes highs. Okay? But so if this can come down, test 173 at least, and then you get an ad, then cool, ad, right? But that's how I do it. So you're making this, it found the low, support, boom, bounced right off of it and went higher. Okay? That's how you do, for me, that's how I do the 2-hour. I use the fib level retracements. Alrighty. That's what I got for you guys in the student request section. We will go ahead and hop in and start uploading charts into the community. If you guys want access to that, the link is in the description. Thanks, guys.